I want to give you a quick training right from our strategy session guide. This is the 5-part Keyspire results roadmap. This is the roadmap that our strategists bring every one of our strategy session callers through to get them clarity, to get them confidence, and to get them going on their next steps. All right, so here we go. Strategy session guide roadmap looks like this. All right, we've got 5 steps in the roadmap. And this is the steps that every investor is going to go through from getting started or getting started with a property, whether it's your first property or your 10th property, right at the beginning to how do we get paid at the end. So let me walk you through them, and I'm going to teach you every step of the way what are some of the things that we want to look at. And then on January 17th, the new Real Estate Advantage, we're going to deep dive into some of these so that we can learn how to apply what we're learning in the new Real Estate Advantage to the 5-part roadmap. And let's get going. I mean, why not? Fund is the first one. How do we fund properties is the first thing that you got to figure out. And then how do we find properties? Once you got the funding, now we got to know how to find properties. How do we buy properties? So very important, how do you make that transaction happen? How do you add value? Like any business in real estate's like every other business. You get paid when you add value. So how do we add value so you can get paid? Step 5 is how do we get paid? How do you get paid as a real estate investor? All right, so I want you to think of these 5 steps. We're going to walk through each one of these steps in this video. And then at our event, we're going to walk through the steps. And then going forward from there, if you'd like a strategy session, you can apply for a strategy session and you can walk through this one-on-one with one of our strategists. All right, here we go. Let me recap them again. How to fund property, how to find property, how to buy property, how to add value, and how to get paid. 5 steps. So let's start with how to fund property. At Keyspire, we've created the 5 funding building blocks. We've realized that every deal is done with a combination of these 5 building blocks. And once you learn the building blocks and when to use them, where they go in the process, you'll know that you can put together a deal, a funding deal, every single time. So I'm going to go over the 5 funding building blocks really quickly here. Number 1 is cash. All right, if you have cash, that's where most people start. I've got some cash. How do I invest it? That really makes you a true investor in real estate because you're using your cash, you're investing it, and you want to get a better return than you're going to get out there in the stock market. Or you want to get a more consistent return that you'll get with anything else you might invest in, whether it's Bitcoin or fine art or fancy cars, watches, whatever you want to invest in. You've realized that real estate is going to get me a more stable, more consistent return. So number 1 is cash, one of the building blocks. Number 2 is retirement savings accounts. So we can often self-direct retirement savings accounts and take some of that savings for our retirement, and we can put that savings into real estate. So over 10, 20, 30 years, we have money growing in real estate. According to the 4 ways to win, we've got money growing over here. Well, we've got other money growing over here in our RSA, or retirement savings account. So that's the second building block, is the retirement savings account. The third is conventional financing. So this is when you go to a bank and you get a mortgage. That's the most typical way to think about conventional financing. Walk into a bank, you want to get a mortgage on an income property. That's conventional financing. It can also be considered conventional financing when you're going and you're getting a line of credit. You know, you might go to the bank, your house may have gone up in value, whether it's the house you own or often another income property. It's gone up in value a little bit, so you're going to get financing on that spread up to, say, 65% loan to value on a line of credit or up to 80% loan to value on a mortgage. So that's number 3, is conventional financing. Now, number 4 and 5 are not often known or often used by investors. And if used correctly, they can be a really, really powerful way to grow your portfolio. Number 4 is private lending. Private lending is often your key when the banks say no, when conventional financing says no, because you become too risky for their models as a borrower. You're too risky because their models are built for people buying their first or second home, maybe an income property. You know, the banks are designed there to get us credit cards, mortgages on our home, things like that. They're not there designed necessarily to help an investor buy 5 or 6 or 7 or 8 properties. And so this is where alternate financing comes in. in terms of private lending. And my favorite way to use private lending is to take an income property I already have, has a little bit of value, equity that's been increased either through the market appreciation or my active appreciation. And I want to take that amount of money. I go to the bank first, and the bank or conventional financing says, no, Michael, you own too many properties. We're not going to lend to you. How many of you had that problem? I talked to a lot of investors. They're like, man, the wealthier I get, the less the banks want to lend to me. And it's really interesting with Canadian banks and Canadian real estate investors how the more property we have, sometimes the harder it is to get a loan. So I say, okay, the banks aren't going to lend to me. I'm going to see if a private lender will cut me a check. And I'm going to secure it on the additional equity that I have on my income property. So that lender is safe and secured. They feel good because they're secured on my equity. I feel good because I just got funding without worrying about my credit or without worrying about all those other things that a conventional lender worries about. And now I can use that money to invest, usually to do some sort of renovation, maybe some bridge financing, so I can either make a great offer on a property. If you saw my last video, I talked about how February is going to be great, so we can do a great offer on a property with that bridge money. And then I am going to have an exit strategy where I'm either going to sell the property or I'm going to refinance, and I'm going to be able to pay that private lender back. Because it's important to note, private lending isn't inexpensive money. You could be looking at 12%, 13, 14% interest, which sounds like a lot of money, and it definitely is if you don't have the cash flow to cover it. So we want to use that for good projects where we have cash flow to be able to cover that. So you're going to learn all about that. If you do a strategy session, we'll talk about that for sure. So that's number 4 is private lending. Number 4 is private lending. And then number 5 is private equity. Okay, sometimes private lending just isn't an option. Maybe you don't have any equity in an income property, or you don't want to leverage your home, or nobody's going to lend you money because you might be uncredible or it might seem too risky to them. Or just the 12% interest rate just does not work in your economic model. When that happens, all hope isn't lost. We've got private equity. What that means is instead of somebody giving you money and being a debtor or a lender on your property that you're in debt to, you bring them in as a partner. So they own a portion of that deal. So for example, the best example is a 50-50 partnership. Is if I am the money partner and you are the working partner, I'm not just going to give you the money and hope you pay me back, even though it's secured on real estate. I'm actually going to come in, I'm going to say, okay, I'll put up the equity, but I want you to make me a partner in the deal. I want to own, say, 50% of that deal. Let's go in 50-50. I put up the money, you do the work, and we will share the profits in some split, usually 50-50. Let's have an exit strategy of after 5 years, we're either going to sell or refinance. We're going to have a liquidity event, and we are going to be able to get paid out after a certain period of time. So that's the 5th funding building block. It's called private equity. Now, when you combine these 5, cash, retirement savings accounts, conventional financing, private lending, and private equity, when you take these and you use each of them as a tool for the most appropriate time and place, you end up with what's called a capital stack. The capital stack is which building blocks in which order make up 100% of the project, the property value. 100% of the property value is made up with some of these building blocks. And I like to think about it this way: is I've heard a lot of people talk about no money down deals. No money down, no money down. Well, there's no such thing as a no money down deal unless somebody's giving you a property for free. So I think of it less as a no money down deal. I think of it more of as a not your money down deal, right? Somebody else's money would come in and build that capital stack. It could be the bank, it could be private lenders, it could be private equity. It could be your own cash. Usually it's a combination of all of these things, and it creates this capital stack for you. All right, so I want you to think in terms of the 5-part results roadmap. The first part is funding, and we want you to know how to build your capital stack so you can fund any deal. Now, once you've built your capital stack, you're going to start finding properties, all right? You want to have your funding set up first, or at least your funding plan ready to go before you start to look at properties. There's no sense finding an amazing property that checks all the boxes, hits all the numbers, and now you're like, okay, let's go find some money to buy it. By the time you find the money, the property is gone. So we want to make sure that we get the funding set up first. That's stage 1. Stage 2 is how to find properties. And we've got 3 really powerful and distinct methods at Keyspire that we teach. We've got the seeker method, the magnet method, and the delegator method. So whether you are out there getting deals yourself, or you're just good at assembling what you're looking for in the deal based on your business and you're giving it to someone else to find for you, one of these three methods is how you are going to go actually find the properties. Once you find them, or when you're looking for them, you got to consider 2 things: the where and the what. Right? What market am I going to go and find properties in? So you have to have things like, we have something called the market scorecard. So you can take different markets and you can score them based on all of the very important metrics: population, employment, migration, all these different metrics that drive market values. We have a market scorecard at Keyspire where our members will just go in, they'll score each market, and they'll be able to tell unemotionally, very simply, which market does the best. So you need some way to quantitatively describe and measure each market. And you need the same tool for each property. So you've got a market and you've decided this is the market, and you have 10 properties in front of you. How the heck do you know which property to invest in? Well, we've got a tool called the 4 Ways to Win at Keyspire, where we analyze and establish cash flow, principal recapture, active appreciation, and passive appreciation. And based on these numbers, we can compare properties within a market that tells us which property is the best property to go for. Because what often happens is you don't have confidence. You might not have confidence in the investing market because you don't have the data in front of you. But once you have the data, the information, and the tools, all of a sudden something happens to your confidence. It skyrockets because you have a system to follow. So that's finding properties. All right, we have the 3 ways to find properties: the seeker, the magnet, the delegator, and we have 2 things to consider with the right tools: what market we're going to go to and what properties we're going to buy within that market. So once you've narrowed it down to the property, you've got the funding, you get to stage 3, and that is buying property, the actual transaction. So what we do is we train our members and people within the Keyspire community, train them to make the right negotiations, put the offer together properly, and also just creating a deal out of thin air where no deal exists. All right, now I'm going to give you a quick couple steps on doing this. Number 1, you have to figure out the motives of the other person. All right, you can never put a deal together till you know what the other person wants. So there's conversations that you have to have. There's specific questions that you have to ask to find out exactly why they're selling or why they might be selling. And then you're going to put together a deal that best reflects why they're selling. All right, you want to really understand their motives, and that's how you're going to start to put the deal together. Once you put the deal together, you're going to negotiate the deal and put in the right structure of an offer. So for example, at Keyspire, we do double offers, we have hidden offers, reverse offers, backup offers. Based on the situation, you want to put the right offer in place so they are the most likely, nothing's 100%, but they're the most likely to take you up on your offer. Then you want to be able to know how to negotiate that deal back and forth, what to say. Ultimately, if you can assess their needs, you find out the motives for buying, and you put in an offer that's a win-win, there's very little negotiation that has to happen most of the time because you've given them exactly what they're looking for. If you give them exactly what they're looking for and that seller is motivated, then the negotiation becomes a lot simpler than if you just put it on an offer and try to hardball negotiation. So that's what most people I think don't understand about buying property and transacting is the negotiation happens, for me anyway, the negotiation happens in the offer design as opposed to the conversation after you've made the offer. So that's number 3, is to buy. Again, this is all in our roadmap. What I'm holding up here is our strategy session guide. We do strategy sessions. They're $297 for a strategy session with one of our senior strategists. And we walk through what the best place for you to start is here. So I'm walking through some of the things our strategist would walk through with you. Number 4 is adding value. You have to learn how to add value properly to real estate, to property. And there's 2 real ways where you can add value. The real main ways to add value are through value-added renovations. This puts you in control of the value of the property. And the second way you can do it is through raising rents. Raising rents is a little bit tricky. There's a lot of legal pieces. But really what we're looking for is for the raising rents piece, I don't want to spend a lot of time there, but if you were looking to add value through raising rents, what would happen? What would be, you'd find a property or a building that's had historical low rents. Maybe they haven't been raised in 5 or even 10 years, and you would just set them at the right market price. As long as you're setting your rents at the right market value, you are just putting rents to where the market need to be. So that's one way. The other way is just increasing the income without raising rents. So can you add laundry? I know Scott tells a great story about he bought a building and he put an antenna on the roof. He rented out the roof for one of these telecommunications antennas. Didn't have to raise the rent for the tenants, but increase the income of the building. And for every $100 or $1,000, well, every dollar you increase the income of the building, you increase the value. So if you can increase the income by $30,000 or $40,000 a year, based on the cap rate in that market, that might increase your value by hundreds of thousands of dollars on a property. And then what do? We can take that increased value, we can go back and we can get more funding for our next property. We can have smart leverage. So adding value either through increasing the income. The second way to add value, and if any of you have seen the show Income Property, where Scott and I have added value to homes, or any of Scott's shows where he goes in and adds value, this is where we love to play, is smart and efficient value-added renovations. So we look at what are the top renovations in each market that are going to produce the most amount of results. And so that's how we think about adding value, is doing the most efficient renovations. There's 2 main categories I want you to think about. Either a renovation requires a permit or doesn't require a permit. And you're going to choose, the reason those are 2 main categories, for me, I chunk those into 2 silos, because if you're not going to get a permit for your renovation, it's really just a cosmetic job. You're going to make it look better. As soon as you go and get a permit for the renovation, there's a lot more involved, a lot more complexity, and that's okay. As long as you have the experience or a coach or somebody to help you back it up, it's okay to go through the rest of that work. So adding value is number 4. Adding value. We can either increase the income or we can do value-added renovations. Number 5 is everybody's favorite, getting paid. How do you get paid on real estate? Now, this seems obvious for some people, but we have to add it because we realize that getting paid, or the options that you would get paid, the exit options on real estate, aren't really that obvious. And I'd say more importantly for you to think about is you want to have those exit options decided ahead of time. So you want to know what your exit strategy is before you ever buy the property. Or you want to think of the end in mind. And so I'm going to give you the 3 top exit strategies that you can run, you can roll with, you can use when you're investing in real estate. So number 1 is buy and sell. That is often called flipping, right? So we're going to flip a property. We're going to buy a property. We're going to somehow increase the value or buy it under market value so that we can sell it at a higher value, or both. We buy it under market value because of clever negotiations and a great finding system, and then we increase the value either by increasing the income or doing our value-added renovations, or both. Now we have a middle ground, we have a gap, we have a margin that we've created, and we are going to sell it at the higher amount, and we're going to take that margin, and that's going to be our gross revenue, our gross profit for our business. So that's one way to do it, is to flip a property. You buy and sell. The other thing you can do with a property is you can buy and hold. You buy the property and you just rent it out. This could be a turnkey property. That means no renovations are needed. Or it could be a full-blown renovation property where you're going to add value and then rent it out. But that's the buy and hold. And the way you get paid on the buy and hold is your first and last month's rent. So you're going to buy the property, you're going to rent it out, and you're usually going to get first and last month's rent right off the bat. So if rent's $3,000 a month, you're going to get $6,000 in your pocket as soon as you rent that property. So it's a great way. It's actually my second favorite way to invest in real estate, is to buy and rent it out, buy and hold. There's a third method that combines number 1 and 2 that is our absolute favorite at Keyspire, something that Scott and I discovered 25 years ago. Well, I shouldn't say discovered, because people have been doing this for hundreds of years. We discovered it for ourselves. We've been teaching people this for 25 years. And everybody that executes this strategy absolutely loves it. On January 17th, we're going to go a little bit deeper into how this works. But the strategy is called flip to yourself. So instead of buying a property and flipping it to somebody else, selling it and they get it, you're going to buy the property and you're going to flip it to yourself. Essentially, you're going to increase the value, and then you're going to refinance it. All right, so picture of it like you're flipping the property. You're doing everything you would do to flip a property, but instead of giving it away, you don't want to give that property away. You've worked so hard to do all of the work. You've done the hardest work possible. You've bought it. You've gone to the lawyers, and you've done all of the renovations, and you've cried on the floor because the tiles didn't work out or the walls in the wrong place. Like, you've got your blood, sweat, and tears. Why in the hell would you want to sell that to somebody else? You want to keep that property. So you do all of the work that a flipper would do, but then instead of selling it to someone else, you simply refinance it. You get a check or a line of credit for the value you've created up to a certain loan to value. You'll get some money out for the value you've created. So you put some money in your pocket. Tax-free money, by the way. When you're flipping, you got to pay tax. When you flip to yourself, you don't pay tax on the money because you've never sold the property. So you get some tax-free money that you can then go and reinvest. This is huge, by the way. If you get $100,000 and you're in a 40% tax bracket, you only have $60,000 left in order to reinvest because you've paid $40,000 to the government. But if you flip to yourself and you get $100,000, you now have $100,000 in your pocket to reinvest. I promise you, you do the math on this, you compound this over 12 months, 3 years, 5 years, 10 years, the impact is geometric. It is literally millions, if not tens of millions of dollars of difference from flipping properties to flipping to yourself. So these are the 3 exit strategies that we teach you. You can obviously tell I'm a little biased of flipping to yourself, which is our core strategy here at Keyspire. But I want you to realize or think about which of these 3 exit strategies are for you or are for the deal before you buy the deal. Look, I'll just really quickly, nothing wrong with flipping. I flipped a lot of properties, and flipping is great in certain circumstances. And sometimes you've got to flip in order to do a flip to yourself. Right? You've got to buy and sell in order to buy and hold. I want you to remember that. Sometimes you have to buy and sell in order to buy and hold when you're starting off. But I want you to think in terms of your more medium or long-term strategy of eventually you're gonna buy and sell, buy and sell, buy and sell, but eventually I want you to buy and hold. I want you to hang on to that property because 5 years or 10 years from now, I want you to write in or see me at an event and say, Michael, I've been buying properties, even just one income property a year for 5 years. And now I have the income, I have the wealth, I have what I'm looking for in life, and I'm living my lifestyle freedom day. That's what it's all about, and that's what we want for you, and that's what I want for you. That's why we're putting on these events and we're doing all this great stuff for you. So there you go. There is our 5-part roadmap right out of our strategy session guide. Obviously, there's a lot of pieces in between. That's what we do here at Keyspire. If you're watching this for the first time, make sure you're subscribed to our stuff because you're going to get more of this. If you're coming to the January 17th event, the New Real Estate Advantage, make sure you bring your notepad because we're going to be deep diving. If you've ever been to one of our workshops or one of our boot camps or our investor summit, we do so many things all across the country. We got an amazing coaching team that can coach you one-on-one. We have a strategy team that will run that first strategy session. Whatever you're looking for, we are here to do it for you. I'm really excited for you to learn more. I'm excited to see you on January 17th. I got one more video coming out in the next couple days that I'm going to make for you tomorrow. So watch that video, watch all the rest of the videos if you haven't seen them, and I will see you Saturday, January 17th, starting 11 a.m. Eastern. We're going to have some fun. See you there.